Hello everyone, welcome back to the channel. In today's video, I will be providing you an overview of Q2 2020 earnings and also share with you why many companies in the S&P 500 are removing guidance altogether. As well, I'll share with you some insights on what to look out for from the consumer discretionary sector, as well as what big banks are doing right now to survive this recession. So please stick to the very end of the video to find out. And if you're new to the channel, please know that I work on videos covering stocks, economics, and other related financial news. And if those things sound interesting to you, please subscribe to the channel and give me a thumbs up. So let's jump straight into it. So as you can see in here, pretty much what I found was that about 80% of the companies in your S&P 500, so about 400 companies, have actually refused to give any guidance over for the last 3 months on expectations for Q2, and many companies for the full 2020 year. A lot of these companies are essentially saying how they just don't have much visibility and it's much more prudent to withdraw it as opposed to give any guidance at all. Just because if they were to give guidance, it would be quite volatile to even begin with. So what investors should really be cautious of is the stock price of a lot of these technology companies have ran up. So what investors should probably be doing is actually be pushing these companies to actually maybe give a little bit more guidance and maybe what they can expect. The next thing here I definitely want to show you is here, according to FactSet, it really shows you the expectations for the Q2 earnings growth is actually not looking great at all. As you can see here, in terms of sectors that's really the hardest hit, you can definitely see consumer discretion is down quite a bit, as well as energy. So these two are the sectors that are not doing very well at all in terms of Q2 earnings expectations. But if we want to be a little bit more optimistic, the one area that is actually doing pretty well is actually the utilities. So for a quick background, the utilities sector, this is really made up of companies that provide electricity, natural gas, water, and also sewage services to people and also businesses. And the reason why there's not much negative in terms of their earnings growth here is essentially because investors will typically buy up defensive stocks from this sector to really help their portfolio throughout the recessionary time. And generally speaking, utilities really provide more steady and also reliable results, even when there is weakness, as there will always be water, sewage services needed by people. Now, I definitely want to show you this is just kind of the expectation for the full year 2020 of the S&P 500 earnings. As you can see, we actually started off in the year, entering into January 2020. The expectation was for the S&P 500's earnings to actually be around 170. So actually a positive increase from 2019. But once the coronavirus hit starting in late February and into March, and even right now, you can see earnings have definitely been revised down all the way to even as low as 128, according to this information that I found from FactSet. So quite a big drop. On the next part here, I want to show you, as you can see, for the current year 2020, expectation for earnings is going to be around the 130, I would say 130. Which actually means the current S&P 500 is actually trading 23 times this year's earnings. So it is nowhere near the word cheap is how I would describe it. And I understand investors are really looking forward to the year 2021. But even then, when we look at 2021, you can see here that earnings expectation is going to be about $163. Now, what this essentially means is that if you actually compare this to the year 2021 with year 2018, 0% EPS growth. When you compare 2021 to 2019, again, 0 earnings per share growth. It just shows you how, even though people think the market can bounce back quickly, this is just a chart where it shows you companies is probably going to take more than, in terms of earnings growth, it's probably going to happen in 2022. I really want to highlight to all my viewers here the consumer discretionary sector. Now, these are very notable companies that have withdrawn their guidance for the entire 2020. And just in case, again, for background here for the viewers, consumer discretionary sector, this encompasses like companies in the cruise line, hotels, casino companies, and also restaurants. So as you can see, this is like the sector that is the most sensitive to economic cycles. So let's see what notable companies and like their CEOs have said about withdrawing their guidance for 2022. So the first one is Darden Restaurant, ticker symbol is DRI. Now, this is a company, you might actually know some of like the restaurant chains, such as like Olive Garden or like Longhorn Steakhouse. They have over 1,500 restaurants location, and this is what they've said. They've had to withdraw their full guidance for 2020. In terms of like the cruise line industry, so Carnival Cruise Line, ticker symbol CCL. Now, they are an international cruise line, and they have over 120 employees. They have over 100 different ships that they work on. And their CEO actually said, given the uncertainty of the situation, they cannot provide any earnings forecast at all. Now, the next company here that I'm sure you all would know is Starbucks. So Starbucks, they have over 30,000 stores globally. And even for them, they're saying, until we can get greater visibility, they're going to suspend like their guidance at all. And then the last company here is the Marriott International Hotel. So they have over 30 different brands and over 7,000 different properties. So again, this is a very diversified like hotel company here. And even for them, they're saying due to the uncertainty, they are not going to provide their Q2 quarterly guidance as well as their full year guidance. And the next part here is when we actually look at implications here. So the Q2 earnings actually begin on July 13th. So it's about in 2 weeks. And your big banks are leading, such as your Citigroup, Wells Fargo, Goldman Sachs, Bank of America, Morgan Stanley. And the thing to really note here is what these big banks will be saying in terms of loan loss provisions. Now, loan loss provisions essentially just means is really like money that these companies set aside to really make sure that they cover any uncollected loans or like loan payments from like defaults that will be happening. So here, this chart here shows you like the 5 biggest lenders have actually stashed away $24 billion in loan loss provisions in Q1, and this number is most likely going to increase for Q2. And ultimately, here's like this Barclays banking director, Jason. He's essentially saying how they're going to expect higher loan losses due to the virus, particularly in like the energy space. And just something to be really like cautious of. So really, in conclusion here, the main thing I want to say is that people are definitely coping to this new reality. Corporations are pulling guidance because they don't have any visibility at all. And these big banks are really increasing their loan loss reserves because there's pressure from sectors like energy, airlines, restaurants, and big banks just want to prepare for any soured loans or credit losses that they endure. So what I want to say is like thank you everyone for watching the video. It means a lot to me if you made it this far. So if you did, please hit the subscribe button for more videos like this, as well as like and share the video. Drop a comment below and I promise you I'll respond back. Thank you everyone for watching. Enjoy your weekend. Bye.